Hi, Joe Lopresti here with the latest Arlington Wealth Management Proactive Strategy Update for Friday, October 21st. Well, since our last update, not much movement from point to point has taken place. However, intraday volatility has been high with large daily swings in the stock market. And volatility is even higher when we look at some other markets like foreign exchange and the global bond market. While not widely followed by many, those markets are even bigger than the global equity market. So the volatility there is something to pay attention to, and we're seeing it very correlated with the volatility in the stock market as well. Volatility in these large capital markets speaks to the lack of liquidity in the global financial system. The Fed is not only raising interest rates, but at their fastest pace ever, but they're also draining liquidity by selling up to $95 billion each month in bonds. And we're also seeing other central banks around the world that are draining liquidity in various ways. So let's take a look at our PAS dashboard. From the standpoint of our models, not a lot of new information to share with you today. We are seeing some, I would say, potential bottoming in our tactical or short-term indicators. So let's take a look there. This is our percent of stocks above the 10-week average on our global universe. And what we could see is that there's a pretty similar setup here to what happened in the summer. So first looking at this chart, we could see it hit a low in September at 12%, pretty low level. Then started to rebound in early part of this month, stopped rebounding and dropped once again, but put in a higher low. And now the latest movement has surpassed the previous high. So that's a bullish setup for this short-term indicator. It's very similar to the bullish setup that we saw here in the summertime. And that led to a pretty good rally that took place till the peak in August. Here's another one of our short-term indicators that we use. This is not part of the dashboard or doesn't factor into our modeling or signaling, but it's another way to gauge the short-term movements, whether there's high risk or low risk, and then movements to the upside or downside in the market. And again, this is a short-term indicator, a tactical indicator. It's our high-low index, and we're looking at the number of stocks hitting new highs globally compared to the number hitting new lows. And then we look at a 10-day average of that recording. And you can see it got down to an extremely low level here back in the early part of this month, 4%. The only time it's been lower on the chart here, as you can see, was the COVID low. So that's a very low risk level. We're now seeing it start to inch up. We're still seeing a high number of daily new lows, but if the market continues to rally, those lows could shrink, and that's what would cause this type of indicator to continue to move to the upside. We haven't seen that higher low and higher high like we did in the summertime, but oftentimes that pattern doesn't develop on this chart. For example, you could see with the COVID low, it was a straight shot back up, and then another period here going back to 2019 that was a straight shot back up. So as you can see, both of those short-term indicators are in position for some kind of rally to occur. Of course, short-term conditions can change rapidly, and these indicators can reverse down again or remain at low risk levels a while longer while the market declines. But we have to look at those two charts and see some short-term positives potentially developing. We wouldn't expect a change in the market cycle back to a bull market, but just like bull markets, they correct to work off overbought levels. Bear markets correct with shorter rallies to work off oversold conditions as well. And it could be that we're due for one of those short-term bear market rallies. And that leads to the next item that I think is important to bring up, seasonality patterns. They're turning favorable for two reasons now. First, the weak 6-month period ends in 10 days, and the strong 6-month period begins. You may have heard the mantra, sell in May and go away, and there is a lot of merit to that saying. In fact, I think it's important enough where I covered that seasonality pattern in my book with the worst and best 6-month period. It's remarkable that nearly all the money made in the market, in the U.S. stock market, has been made between November 1st and April 30th. Very little is made between May 1st and October 31st. So that's why they're called the best and worst 6-month periods. So maybe in our next update, we'll show you these statistics. Well, November 1st is right around the corner, so that stronger 6-month period is approaching. The second seasonal trend to be aware of is the presidential election cycle. It turns quite positive right about now and continues into the middle part of next year. Typically, strength builds just before the midterm election and continues into the middle part of the third year of a president's term. So this graph shows the average 2-quarter market performance by presidential cycle, from the worst to the best. And the worst 2-quarter period just concluded. That ended on September 30th with the third quarter of the second year of a president's term. The best 2-quarter period just started and ends with the first quarter of the third year of the president's term, which would be the first quarter of next year. And that's followed by the second best 2-quarter period, the second quarter of the third year. So seasonally, from an election standpoint, we're in the sweet spot. Oftentimes, I believe that's due to the fact that many times during a midterm election, you're seeing some power change, some shifts in the balance of the government. Oftentimes, it moves to a stalemated type of government. And while you would think that would be bad for the markets tend to like stalemated government because not a lot of extreme policies can be enacted during that type of government balance. Now, these seasonal patterns do not override our proprietary models. PAS calls the shots. For example, during the last midterm year, 2018, PAS was also on a global sell signal at this time of the year, and the markets did not bottom before the election or near the election. They continued to drop materially until a low reached on Christmas Eve that year. So here's our 210-day indicator showing that time. There's the 2018 period. You could see that this indicator reached the low risk level. That's a selling climax low toward the end of 2018. Now, importantly, our economic models were not warning of a recession then. So selling climax levels are generally good entry points if the economy doesn't slip into recession. You could see the current level is very similar to where we were in 2018. But our economic models override tactical buy signals like this because we have to expect the bear market to be much longer in duration than bear markets without a recession. However, a short-term opportunity may be in the offing in the near future. As I said earlier, even lengthy bear markets will experience intermittent rallies to work off oversold conditions. You know, we're in that seasonal period now where strength does tend to build in the market. So we're going to be on the lookout for tactical opportunities in the marketplace as well. You know, during lengthy bear markets, a tactical approach may be one of the few ways to make some progress in what might otherwise be a long time of waiting it out for our next buy signal to develop. So we'll continue to keep you posted with our thoughts and the action in our models with our biweekly updates. And if anything material occurs in between updates, we'll send out a flash alert. Thanks very much for watching today. Enjoy your weekend.